Good afternoon. Welcome to Options Brew TV. I am your host, Lex, and with us today are Chris Siddell, and he's going to pronounce that for me when he comes on, and Will Wise. We're going to talk about some institutional sort of things, I think, and hedge fund sort of fun. But I think these guys are they're going to really explain this well. I've been on with Chris before, so let's tune them in and get ready to roll. Buckle up. Welcome, guys. Thanks for coming on. I love it. Chris down below. Oh, I don't have your little banner things on. What the heck is wrong with me? Let's see. I can put your names on. Will and Chris.
Oh, there you go.
Perfect, right? So Chris is coming to us from New York. I think I got that right. I hope I don't reverse it. Will from Florida somewhere, right?
Correct. Yeah.
Okay. Thanks for coming on. Chris, I said your last name wrong, right? And I even have it like phonetically written down here.
Siddell. I mean, people say like Siddell.
I know. I was gonna be like Citadel. That's not gonna be it. Siddell, and I have it written down that way. So sorry about that. Oh man. Well, Chris, you've been with us before. We did a great show probably a year ago. You said earlier, right?
Yeah.
So that was really fun. I think we talked a good bit about tail risk. As you know, and I told you guys this before, our audience is retail. Right. So you guys, I think, live in what I'd call an institutional space. Is that safe?
Yeah.
Okay. So, what I found is I've been doing these speaking engagements around the country. So we've actually been traveling again. And I talk a lot about what we call the dealers side of the equation. So dealers to me just means market makers, the other side of the bid ask, right? Where retail traders trade on. And I find that the retail folks, they tend to not understand the dealer side of the equation so much, and even the institutional side as well. So we love this kind of content. I think we get a lot of questions on this stuff a good bit. I think the retail folks, they love to understand it, but they're not sure how to use it. So I'm hoping you guys can shed a little light on this today with us. So let's start off. Will, I'll start with you. Give me a little background on your career path, how you and Chris met, and Chris, I'll give you a chance to do the same.
Yeah, absolutely. So I had a somewhat unorthodox path to a hedge fund. I actually began trading retail, and I began in my dorm room. So I was in college during the Great Financial Crisis, and I'm from right outside New York City, where financial careers are somewhat ubiquitous. And as an adolescent, I was just trying to solve the problem: who the hell would do this to themselves? It sounds insane. And that just led me on a career-long path to figure out different positive expectancy trades that existed in the markets and how I might even be able to carve a career out of this. So I did go on to found a digital advertising company, and some of the money that came from that I used as an independent high-stakes trader.
Mm-hmm.
And I cultivated strategies in both the big CTNs and then a flow strategy in microcaps, utilizing secondary offerings and some of the hedge funds attached to those secondary offerings to kind of identify where we might have really substantial order imbalances. The analogy I always like to use is that you see the National Geographic specials and there's a blue whale eating all the plankton. I was the tiny little guppy over his head, getting a little overflow. But I always had a thirst for learning more about markets, and in networking, I met Chris, and twisting his arm finally got him to create a professional relationship with me. And here we are at Ambrose now.
Awesome. So Ambrose is is it the hedge fund? Is that right, guys?
So it's a two-pronged business. The Ambrose Group is actually the RIA, and Ambrose Capital Management is the management company for private fund.
Okay, great. All right, good, Will. And Chris, I know people have seen you before here, so give us the rundown on your path too, please.
Yeah. So started way back in the day. Learned under which I think you and I spoke about him on the last episode, but learned under Bob Cantor, who's pretty
SIBO guy.
Yeah, pretty famous SIBO legend.
Right.
And from there I went to two different prop desks, spent some time there, and then went to a large Canadian investment bank where I spent most of my time on the exotic derivatives and listed options desk. And throughout the time you meet people, and you're in these like different Bloomberg chats, and you're in different trader chats and stuff, and you talk with people. And Will and I had developed a relationship, through just through talking about trading. And one of our other partners, who's actually an ex-Citadel guy, same way. And yeah, we kind of just came together from there, when we started understanding that the market and the market microstructure was changing. We looked at it and we said that this is a really opportunistic time to start a hedge fund that's focused directly on vol like this. So far, it's been pretty good. 3 years and pretty good so far.
Oh, that's awesome. So when you talk about volatility, is this higher implied volatility environment better for you two or not? Would you say?
So it's somewhat unique. We trade tail risk, right? So we're
you know what I'm going to ask you, Will, right?
What's that?
You know what I'm going to ask you. What is tail risk, right? Remember, I'm dumb. I don't know this stuff. So you got to tell me what tail.
There's going to be a stickler out there who is looking for a very technical definition that
we don't need that.
Not going to actually hit, but the general idea is it's 2 to 3 plus standard deviation moves that have catastrophic effects on portfolios.
And those aren't supposed to happen more than 2% of the time, or somewhere thereabouts, or 0.5%. The three,
right?
Correct.
Right? But
they seem like they do in the markets.
We are very bad at actually forecasting how frequently they happen and what we would consider to be quote unquote a tail risk event. And then 2, even if they became more rare than they currently are, depending on your age, you still have a fairly high likelihood of living through one, and it could have catastrophic effects on your finances if you don't account for it.
Right. Okay. So I'm an older guy, and I've lived through, I think, 4 of them. Seriously, they shouldn't happen that much, I don't think.
Yeah.
But they have. So I made the 87 crash. I was on the floor. I made 92, which people don't really talk about. That was United Airlines kind of going almost belly up. So that was a pretty big crash, right? 2001, the towers came down. That was pretty catastrophic. And then 08 for sure. And I don't know what you call this current environment. I mean,
COVID, I would definitely.
Well, yeah, COVID is big.
COVID.
I got 5. I got 5 in me. It's unreal.
Yep.
So you guys then, your hedge fund protects for these sort of catastrophic event, or no? Is that not it?
Specifically an equity vol, right? So theoretically, a tail risk event could be a tornado coming through Kansas, and you don't have an allocation protecting against that. But yes, equity volatility-based tail risk, that's what we're covering against. So that's what we're aiming to cover against.
Okay. And then Chris, you're doing this. You guys are in the same, department of the company. I think you said earlier, there's an advisory group and then a hedge fund group. Are you both in the same ones, or are you in separate ones? Or?
Yeah. So it's pretty much, the same sort of titles. The difference in splitting up the 2 businesses is for the RIA side, it's more tailored towards larger individuals who would want more custom hedging solutions or different sort of solutions, right? Or we may come across investors that are like, hey, you guys do a good job trading. We have an interest in you trading absolute return stuff. So that's really the arm of the SMA, but the hedge fund is just entirely to hedge an individual's portfolio. So like, let's say if you have an institution or an individual who has some sort of exposure towards stocks and they're worried about the stock market crashing, they'll take a piece of their portfolio and pretty much invest it into the hedge fund. But the responsibilities of both sort of firms are literally the exact same. So it's like Will and I, we handle this stuff together on a day-to-day basis.
Okay. So with the hedge fund part of it, so you'll actually have, if I had a portfolio of stocks, I could come to you and say, hey, I'm worried about downside, tail risk, whatever it is. Can you take a part of this and manage it for me? Is that kind of the idea in a nutshell?
Yeah. Yeah, pretty much.
Okay. All right. So I guess my next question then is, you hear about how tough it is to be a market timer. How do you time this? I mean, it's statistically, it sounds like you're not winning very much, right? Because these 3 SD moves don't happen that much. I went through 5 of them in my life or my career. That's not a lot. I mean, I think I've struck out in baseball more than 5 times. I know that. So, how do you time this stuff, or is it just kind of a different equation?
Well, you have a consistent exposure. You're not actually trying to forecast the event happening. That would be wildly unsuccessful. The
Yeah.
idea is you pre-hedge, and that's really in our opinion, that's really the only way to successfully account for a tail risk, is that you have a continual allocation to something that's robust against a tail risk, and you keep that funded at all times.
Got it.
I would also say it's notable that what you described is really important. There's an inherent bleed that comes with waiting for a massive outlier. And so we have an alpha-based strategy where we're actually trying to generate absolute return against the inherent bleed that comes with investing in tail risk.
Okay. So you offset some of that bleed with that other strategy. That's interesting. Yeah. So, it's funny. We talked about COVID, or we mentioned COVID. I have a friend who's not in the industry, who's in the restaurant business, very successful. So guess how that business went the day COVID happened? Not good, not well. So we started talking about, VIX options and this and that. And he was asking me all kinds of questions. And he says, well, why wouldn't people in my business or any business like that could be turned off overnight buy the insurance policy of, out of the money VIX calls? And back then, I'm guessing the VIX calls were probably no bid at nickels. And if you're going to bleed month after month, but one time when it happens, you're going to, kill it. So it's insurance, right? I mean, you're supposed to lose on it for the most part until you really need it.
Yeah. Chris and I say that all the time. You should normalize insuring a portfolio. There's so many things we insure. Don't even think twice about it. It's unlikely we're going to utilize the insurance. House, heaven forbid, we don't want to use it, but we have it. Car, expensive jewelry. Portfolio probably accounts for a very substantial part of your net worth.
Yep. Right. Now, do you have
ways you can feasibly insure that?
Oh yeah. Do you have certain criteria that must be met for an individual or entity to use your service? Is it like accredited, D investors, or I forget what they're called now? I actually took a series test. I was supposed to know that, but I forgot it.
No, it's okay. We are bound to taking only accredited investors.
Okay. So, and there's no other way around that, right? For what you guys do?
No, unfortunately.
I'm not trying to get around the regulators. I swear I've had enough of them in my backyard before. So
yeah, a lot of people, believe it or not, we get this question quite often, that some people don't even realize that they're accredited investors, and they'll come to us and they'll fill out the little thing on our website, and they'll be like, oh yeah, I didn't know I was accredited. But I'd say it's there for a reason, right? Because I think actually the irony to me saying that is, how you were just talking about your friend. I remember I had a dinner in New York with another vol manager, and we went out to eat with a doctor, and the doctor had the same mentality. The doctor said, we're actually all friends. I'm just referring to him as a doctor to just remain anonymous. But, he says this all the time, where he's like, look, I'll buy a bunch of puts to ensure the safety of my business. And I like that. Like, I like the fact that, I know that I'm protecting my business against a tail risk event.
Sure.
I say the difference in what we do than most other tail risk funds kind of lies onto what Will was saying before, which is we've run a couple of other strategies that offset that bleed, so that you're not decaying away that amount at that rapid rate, right? Because if you have a strategy that is returning 4x, but they decay away 70-80% or the crash, all you're doing is kind of getting back to even. So sure. I think it's an important feature as well to be able to manage kind of both sides of that equation, and then it gives the investor a more holistic and a better, hedge.
Yeah, no, that makes sense. That's a good point.
To even further Chris's point,
Mhm.
part of the rationale for carrying tail risk is to have cash when the fire sale prices come around, right?
Right.
So if you're not achieving that because you bled so much before any of this occurred, it's purposeless. It's a nice idea. You do need a way to make the cost of insurance really equitable for
Sure.
it to have its maximum value.
Yeah. So you're saying you should do the opposite of what I've done in my life. Like I always had cash when I didn't need it, and when I needed it, I never had it. Right. So don't do that.
That's the opposite of serendipity. Yes.
I'm kidding, but no, it's I remember in the day when some of these events happened, man, the people who were positioned well, they were very calm and made much more money, right? As a result. So yeah, and the first one was the 87. You guys probably weren't even around in 87, but it was amazing because it was really, notionally not a very big number, the drop, right? And it's percent wise, it was huge, and people just were like, "Oh my God, I'm gonna die here." It was so awful. I was on a trading floor then, and people actually left the floor and just, I don't know where they went. They left. They couldn't make markets anymore. So there's only a few of us still standing down there. It was nuts. Of course, I didn't know what I was doing. It was my first year.
That's quite a welcome to the industry.
Yeah, I was like, oh, this is great. I looked at my account with my backer the next day, and I had no idea how to read the sheets. I said, I don't know. There's a couple negative numbers here. There's a few positive ones. I think I did okay.
Yeah.
So,
No, so you make a really good point, because you're talking with senior traders. They always talk about the events that change their life.
Yeah.
And from my experience, what I would categorize as good traders is the individuals that take advantage of this type of outlier event that has this massive component of convexity to it. And it's like, if you set yourself up for this, it's not like a lotto ticket. It's actually just like you said, right? You ran into it 5-6 times in your lifetime. And depending on your age and who you are, you're bound to run into that, maybe more or less, but it will happen. And I think the individuals that position themselves have done really well in financial markets. And I think it's just a byproduct of how financial markets just work. It's like,
right.
There's not really tail risk events. It's what we deem as a tail risk event and what we price as a tail risk event, but the market's going to do whatever it does.
Sure.
And it, kind of shows you itself that opens up to that type of payout.
Yeah. No, those are great points. I think, what's your answer to the people or the managers who say to a young person, someone like my son's a young person, right? And he's got some money, and they say, there's going to be events during the course of your life that are going to be, bad scenarios, and market's going to be terrible. But over time, if you look back historically, that old argument, the market is historically up X% for the last gazillion years. And if you don't need the money, don't look at it, let it be. So I'm not saying I believe this. I've heard this said before, right? And I know you guys have too. So what do you tell that person? Is that person kind of right or not really right?
Yeah, that's like portfolio management 1.0, and we're offering 2.0, because they are partially right?
Yep.
That's not an incorrect argument. We actually did a paper in which we highlighted what the return would look like if you omitted, I believe it was the 20% drawdowns between 2000 and 2020.
Okay.
And don't quote me on it, but the nature of the returns, it was like it tripled.
Really?
Yeah, obviously entirely omitting those negative 20% periods is somewhat impossible, but it shows that limiting variance drag, which I'm sure you're queuing me up for a question here.
Yeah, you're going to get it. You might as well tell me what it is already.
So it's the notion that, well, think of it in these terms. The lower the realized volatility of a portfolio, the more the portfolio will return. So if you started with portfolio A and it had $100 and it went negative 10% year one, so it's down to 90, positive 10% year two, returns $9, it's at 99, right?
Right.
So mean return 0, actual return negative 1%. If year one instead, portfolio B, $100 was negative 50%, it's down to $50, positive 50% return makes 25. It's at 75.
Yep.
Mean return 0, actual return negative 25%.
Mhm.
That limited volatility led to a better result. And I think that's the most simple way to sort of explain that. Limiting variance drag has a positive effect on portfolios, and that's something tail risk is able to do.
Yeah, I actually have another point to Will's point, because you know, it's like I look at it as more applicable to a person and the way how they think about their day to day and their life. So in that same paper that Will's referencing, we also showed how long it would take for an individual to get back to break even if you bought the tech bubble in '01, right? So a lot of people have this mentality that it's like, yeah, just buy the dip because and hold and you'll never lose money. You know, this equity risk premium will show itself. But this is the problem, and there's this buzzword that gets tossed around a lot that's called ergodicity. And you know, you ask a million people to explain ergodicity, they'll all explain it in different ways. But pretty much this sort of time frame that you're in, you don't know what is going to be the situation that's going to affect your life during that time. So buying the dip may have worked for Lex, because when he came in, you know, he bought the dip at the right time and it took 2 years to rebound. But we may be in the whole spectrum of the distribution. You may be in the spectrum where, yeah, I do this now, but it takes me 25 years to break even, right? So imagine you as a tech investor, you know, in '01, and you went with that same mentality where you were like, oh yeah, I'm buying the dip. Well, it took you 15 years to break even, right? Just even where you could have compounded returns significantly before that. So it's like, you know, investors who try to invest with that approach, it's more like a straw man's argument. You know, it's kind of the easy way out, that it's like, oh yeah, just buy and hold. That's the stuff that like a financial advisor would tell you, you know, because they kind of want to keep you on as a client. Whereas when you look at the reality behind it, it's that you may just fall on the wrong spectrum of that, and that bad luck could cost you, you know, 25 years of investing in your wealth.
Right. So the coin can actually flip 200 heads in a row, technically, but and you don't know where you're going to be along that path.
Exactly.
Right. And you might catch I would catch the 200 heads in a row, and I'm saying tails every time, right? It can't be another head, right? That's what I would do. But no. So do you guys? Is there some? If you're hedging that downside, is there a give on the upside? So let's say the average portfolio returns 8% over this time, right? And those bad dips are terrible for them, but overall it's 8%. Now, are you eating into that 8%? Have you enhanced the downside and enhanced the upside as well? Does that make sense, that question?
Yeah, that question makes sense. We're not aiming to enhance the upside.
Okay.
It would probably be a reasonable expectation to think that we took a very, very minor piece out of the upside. It would sort of depend on how well we did that year with the absolute return strategies.
Yep.
But the point is certainly for you to be able to aggressively partake in the upside. And I would actually say that if you had the downside protection, you could allocate more funds to being long equities, because you know you have something covering your back.
Sure.
So although we might dent the percent return a little bit, you could argue that you could allocate more capital to the strategy.
Okay. So I'm sorry, go ahead, Chris.
Yeah, no, I was going to kind of jump on what we're saying there. I think really the way how we look at it is stick to a process, stick to these certain edges that we know exist in the market, and trade these edges in a defined way so that we can minimize the bleed, and at the same time be purchasing a lot of these way out the money tails. Holistically, what this looks like is our goal is to remain as close to flat as possible if there is no sort of burst in volatility. So, you know, if there is no sort of big spike in VIX or S&P fall, you know, we're going to be close to flat or aim to be close to flat. And there is, you know, we're trying to return multiples of the investor's money. And that's really the goal. So, you know, in a scenario where the market goes up 20%, our goal is, you know, just remain close to flat or slightly positive or slightly down. That's really the
okay
we play in.
Okay, got it. So what would you recommend if you can? Someone has I'll just make up numbers, a $10 million portfolio. How much of that 10 million should be allocated to something like this in percent terms? There's no answer. I don't know.
Everything in investing will come down to personal appetite to a degree, but we aim to 5 to 10%.
Okay, that's good to know. That makes sense. Okay, interesting. And the other 90% ish in crypto, right? Just go long.
Well, specifically the obscure coins too.
Yeah, the ones that you don't know where they are.
Yeah, Dogecoin.
There you go.
Should be clear, that's not financial advice.
That is not financial advice, right? Okay, a couple more questions here. I thank God this StreamYard gave me the timer up top. I know how long I've been babbling over here. Sorry. My other question is, obviously there are better times to do this than not, okay, relative to implied volatility. So do you have some modeling that looks at skew and those sort of things and where implied volatility levels are to historical implied volatilities, or does that not really matter? Or is that a big part of the deal?
No, that's a big part of the deal. We want to be opportunistic and accumulating as much cheap exposure as we possibly can. And so the historical relationship of skew and the levels of implied volatility are very impactful in that, even in sub 5 delta options.
Okay. Were you going to say something too, Chris? Sorry.
Yeah, no, I'm in complete agreement with that. A lot of our process is focused around a quantitative approach and identifying some of these things. I'd say we have more of a discretionary overlay than most other quantitative firms. So I'd say we're like 80% quantitative, 20% discretionary. But ultimately, this really comes down to understanding what you categorize as relatively cheap and when to be inventorying that type of exposure. Because I think the biggest problem with trying to hedge is hedging at the wrong time. And what you see in a common frame is this mentality that investors have herd mentality, right? So it's like, I want to hedge when CNBC is talking about markets in turmoil. I want to hedge when everybody's talking about the VIX going to 70. That's when this becomes in vogue. But I think what you'll notice around some of the smart investors is this process around doing this way ahead of time, hedging when it's more opportunistic. And ironically, even in a year like this year, where the S&P has dropped, last year, we're now January 4th. I'm so used to talking about 2022. Last year, where the S&P dropped around 20%, but implied vol stayed relatively muted. And you look at some of the VIX vol, it stayed relatively muted. You look at the tails, and skew is completely destroyed. So for what we do, which we focus directly near dated vol, it's a pretty opportunistic time, which is shocking. It's like, it's as shocking as saying that, hey, my house is on fire, and this insurance company is offering me insurance for 70% less than what it is generally on average, right? Somebody would look at you and be like, no way. But effectively, that's what we're seeing, and that's what we're seeing in the pricing in today's environment.
So what's any reason for that, in your opinion? I do a lot of seminars on dealer gamma clusters and Vana and Charm and those sort of things. So maybe I haven't paid attention to it lately though, but maybe it's something along those lines, that the dealers are pretty well hedged and aren't pushing these markets wildly to the downside like they normally could.
I think it's two prongs we like to focus on when we sort of describe this phenomenon, particularly as it played out in 2022.
Yep.
Vol is really badly affected by unforeseen events. And it was kind of easy to foresee that inflation was pretty extreme and that the economic environment was going to become less conducive to growth, right? With Fed tightening and the literal objective of the Fed being to rein things in.
Yep.
There wasn't a complete shocker. There wasn't a COVID type event that, blew everyone out of the water. I think that's one. Two, there's a structural dynamic for yield generating strategies in which advisors put clients into products that sell options. And when you couple that with not having the blowout event, you get one natural suppression and one sort of unnatural suppression, and it just leads to lower prices or lower measures permeating through the market.
Mm-hmm. Mm-hmm. That makes sense. Yeah, those are good points. Now, when you guys hedge a portfolio, is it a macro hedge, meaning an SPX type product, or are you doing individual equity hedging on with the puts and the like in the products?
There is single stock involved, but the objective is to keep someone who has S&P exposure, make sure that there is no correlation risk there. We are keeping them heavily hedged.
Okay, good. All right, good. Well, that's awesome, man. I love it. It's Ambrose. Did I say that right? Since I can't say Chris's last name, correct?
Yeah, everybody says Ambrose, but
I even practiced Ambrose before I kind of put the emphasis on the first part of the word. I thought I got that right. Ambrose.
Yep.
Oh, I love it. Ambrose Group. Okay, good. All right, well, good. This was awesome. It's great to chat with you guys as always. I love this kind of stuff. So, and our audience really eats it up too. So I appreciate you guys coming on. Stick around for afterwards. We'll chat a little bit. And, thanks again. It's awesome.
Yeah, I appreciate it. Thank you so much.
Thanks.